Vikas Khemani joins us, and he is running late. अरे मैराथन भागने वाला लेट टाइम पर आया है टेलीविजन इंटरव्यू के लिए.
You were busy work.
And how is this close by to your office? So you cannot say that I got stuck in Bombay traffic.
Closer you are always late.
How you been, my friend?
All well. Super.
This market is not giving anybody a chance to even buy the dip. The dips are either intraday or they last for a few seconds or few hours. What is the best way to approach this market?
Kunj, we've been talking about this. I think most people have been wanting to buy the market on the dip since 18,000 of Nifty. And in my opinion, it's a futile exercise to do that. I've been saying this for quite some time and there's a nice Peter Lynch saying that more money is lost on waiting for correction than correction itself. Especially when one is long-term investor, one is looking to allocate capital from medium-term to long-term perspective. It makes no sense to kind of keep looking for that. Idea is to invest into companies which are, have fundamental, sustainable, long-term growth, sectors which have a lot of tailwinds. And, if you again look at, and we discussed this in the past, that over the next 10, 12 years, India is in one of the most transformative phase where our earning will go from corporate earning of India will go from $150 billion to $1 trillion. It means our market cap is going towards the direction of $22 trillion. And today we are at $5.5 trillion, right? So if you have that kind of journey ahead of you, really whether you buy Nifty at 24,000, 23,000, 25,000 doesn't matter. Of course, you have to you have to have the right perspective. And when tomorrow something were to change, let's say in a shorter term, one should be able to hold on to that. And I can tell you short-term risk is same whether Nifty is 25,000, 18,000 or 10,000 because short-term risk come always from unexpected sources and when you are least expecting, right? So, you can't budget for that. You can't plan for that. And so my view has been that, in this transformative journey of India, idea is to remain invested. And I don't see many structural risks in the market. Tactical risk always comes from, but I don't see many structural risk at all in the market.
On Warren Buffett's birthday, you're talking about Peter Lynch quotes.
Even Warren Buffett said that, right? That you are investing into parts of the business, and as long as and I can tell you in this markets, we are able to find companies which we think can grow and at a reasonable valuation can grow over next 8-10 years sustainably. We are able to find that. To be honest, I don't find markets very expensive. I don't find, of course, markets are not cheap, but I don't find markets very expensive. There are pockets of exuberance. There are pockets of excesses. You got to avoid them. But that is true in any market. So I do believe that one has to look at this market whenever most of the people who making the argument that reversion to mean kind of situation. Whenever you are in a transformative journey, that reversion to mean doesn't work because reversion to mean believes that you are in a you are not in a transformative journey. You are how you have historically been. But India is not how India has been historically, and that's a very big difference and perspective. How should you look at India?
Tempted to know, Vikas, hi morning. What's looking cheap to you right now?
I said, you are not looking for any cheap stocks. We are looking for fairly valued stocks or reasonably valued stock, but where there are sustainably good long-term opportunities there. And, we find, the last 5 years, we never bought consumer stock, but recently there are lots of interesting ideas, especially in consumer discretionary stocks, where there's a good growth ahead. There's a good sustainable mode and there's demand coming through. Manufacturing continues to remain very, very interesting and exciting. We are again able to find ideas within, specialty chemicals, auto component space, pharmaceuticals, So I think there are ideas I can tell you practically every segment, even infrastructure looks very interesting. Within that, EPC companies are doing very well. And as we know that India is spending massive amount on building everything, and the handful of companies which can build India, right? So where do you find these kind of setups where there's a lot of work and less competition? So you can find various pockets of interesting ideas. You don't have to necessarily focus only on the exuberance part of the market.
Getting a take from you as to where you stand. I know you spoke of very different pockets and where there is, of course, value, but this PSU trade, because for the longest time, the markets were harping on how there is so much value, and we had seen the stocks actually perform. And then from those July peaks, they've really come off quite significantly. So where does one stand when it comes to PSUs? Is this just some sort of an aberration or signs of a long-term trend weaning out?
I think again, PSU, there's no sector called PSU. Again, depends on PSU is an ownership structure, which I think is fine. I don't think there's anything changed negatively on that aspect. Within PSUs, of course, there are banks and defense and different players. We've been quite positive on PSU banks, but I think in the recent past, we have seen some correction, but that's okay. We are not seeing any structural problem in that. Credit growth is strong. I think there's a bit of a pressure, as talked about, on NIMs, which so far is not reflected in any of the PSU numbers. But the valuations are 5-6 times P's, and in between 1.5 time book, good 17-18%, 15 to 18% kind of ROE range. So we are not worried. I think they will. If India is going to take the credit outstanding from $2.5 trillion to $65-70 trillion. There are a handful of banks in India. I mean, we don't have many banks, and these are the banks which will grow. So it's a perspective which is missing. If you're looking for a technical, I have no idea, but I think, in my opinion, most PSUs in the banking space, and especially, even in, for that matter, other spaces will do well as long as their sectoral cycle is in place, which I think, at least for defense and banks, looks well in place.
Invested in this market, what is the best way to approach?
Best way to approach, don't look at markets every day, remain invested, longer your time horizon. If you have a shorter time horizon, please don't invest. And again, avoid exuberance, because FOMO is the worst thing to have in this market. We have seen that same thing had happened in 21 as well. So don't invest out of FOMO just because something is doing well. Avoid pockets of risk. I think, we have seen significant pockets of risk developing in the market. I always look at whenever poor quality companies and poor quality managements are able to IPO and raise capital in the market or do QIP or pref. I think these are the kind of signs of worry. But these signs of worry can continue for long, by the way. Idea is to choose your narrow range of good business, good management, and if some short-term correction comes, be with it. So be it, because ultimately only the longer horizon will help you create significant wealth in the market.
All right, Vikas, appreciate your time and glad you could join us.
If you like this video, then like, share and subscribe to ET Now.